Which is the best explosive growth stock to buy right now? Is it ChargePoint stock or is it Rivian automotive stock? I'm going to answer that question in this video, comparing the two growth stocks across four different metrics, starting with revenue. So let's begin. Looking at ChargePoint, you see trailing 12-month revenue here rising exponentially from around 150 million in early 2021 all the way up to 468 million as of its latest update in 2023. So you have revenue that tripled in a short amount of time. Now that's nothing, that looks like nothing compared to Rivian's trailing 12-month revenue rising from around 500 million to 1.658 billion in less than 1 year. So you have two incredibly explosive growth stocks here. And what makes these companies especially explosive is that it's not the case where growth is mostly in the past for these two. Most of the growth these two companies will experience is in the future. This growth rate, while the rate of growth, they may not triple every year in revenue, but they are likely to grow in terms of total absolute value way more than they have in the future versus the past. So you look at Rivian's grown revenue by, look at total numbers, not rate of growth. It's grown by about a billion in a year. Now you can expect Rivian's revenue to grow by several billion over the next few years, and over the next decade by much more than that. Similarly, ChargePoint has increased by roughly 300 million. You can expect that to grow exponentially over the next several years. In fact, for the next quarter, ChargePoint is forecasting revenue over 100 million. So for the next quarter, ChargePoint is expecting to earn more revenue than it did for an entire year just a couple of years ago. That just, puts into a little bit of perspective the kind of growth these companies are experiencing. Now, these two both benefit from the tailwind from expanding market for electric vehicles. Still, overall, around the world, electric vehicles make up around 10% of total car sales. I wouldn't be surprised if in the year 2040 that ratio is flipped, where you have 90% of cars being electric vehicles and only 10% being internal combustion engines in 2040. It's the opposite right now. It's 90-10, where 10% is only electric vehicles. So each of these two will benefit from that explosive growth in the industry, and they're positioned for that to capitalize on that growth in the industry. And as an investor, these two are certainly options you can choose from if you want to capitalize on the growth of that industry. Let's look at these two companies in terms of cash flow from operations to sales over the trailing 12 months. And in this metric, I totally expect these figures to be negative. These are two early stage growth companies, and it's reasonable to have negative cash flow from operations to sales when you're still in the early stages of development, early stages of growth. But what I want to see is the metric improving. I want to see the negative numbers decreasing or getting closer to zero and eventually being positive. And I do see that from both of these companies. ChargePoint, you see their cash flow from operations to sales had been declining and then has turned around and is on its way higher. So it went all the way down to negative 68%, but now it's improved to negative 57% in its most recent update. Similarly with Rivian, although Rivian has shown even better improvement in this metric from negative 800% to negative 304%. So Rivian is showing more improvement, and I expect Rivian will continue showing better improvement than ChargePoint on this metric because that's just the nature of car manufacturing. You spend a lot of money up front in the design, the research and development, in building out the manufacturing facilities, and that's a lot of upfront cash expense. And then later on, you start to recoup those as you gain the cash flow from the sale of each car. So right now, from the sale of each car, Rivian is recouping some of that cash flow from operations that it lost earlier on because more of its spending was on research and development and manufacturing facilities. Now, more of its spending will be on the per unit costs of making a car and then selling a car, which is less capital intensive than the research and development, than the building out the manufacturing facilities. So over the next several quarters and next several years, Rivian should be able to improve this metric faster than ChargePoint, I should note. The next metric I wanted to look at is the operating profit margin over the trailing 12 months. And I'm expecting similar factors as I did with the cash flow from operations. I fully expect to see negative numbers. These two are explosive growth stocks in their early stages, so it's reasonable to expect negative profit margins. But again, I want to see improvement, and I do see that. Looking at Rivian first this time, you see Rivian's operating profit margin improving drastically from losses over 1,000% down to negative 400%. Again, for the same reasons I mentioned earlier, much of the losses were already experienced up front during research and development and building out the manufacturing facilities. Now it's in a stage where those losses should start to diminish, right? And ChargePoint also experiencing losses and then turning things around now, making progress towards profitability. Its operating profit margin negative 73%, better than Rivian's, and also improving as well. So each of these explosive growth stocks moving in the right direction. And finally, I wanted to look at valuation, and I chose to use the forward price to sales ratio because each of these two stocks are significantly negative in terms of cash flow and profit margin. So I chose to use the forward price to sales ratio. And looking at this metric, they are both down significantly off their highs, but Rivian is trading at a forward price to sales of nearly half of ChargePoint. So Rivian is at 1.561, whereas ChargePoint is at 2.954. So if I had to pick one of these two explosive growth stocks to buy right now, I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. I would pick Rivian. I would pick Rivian. But I will note that this is a difficult decision to make because they are in such early stages of development here. So it's difficult to assess the progress and the prospects of a company when you have such little history to judge them on. So these two especially now, they are explosive growth stocks, but they also have much higher than usual risk. So just keep that in mind if you're thinking about investing in either of these two explosive growth stocks. Keep in mind that they do come with very high levels of risk. That means in any given quarter, each of these two stock prices can increase or decrease substantially. If Rivian and ChargePoint have a really good quarter where they make excellent progress and take really good steps forward, the stock price could increase really rapidly. Think 50%, 75%. But at the same time, if they have a really bad quarter, their stock price could decrease by a similar amount. So the quarterly fluctuations, the daily, weekly fluctuations in stock price are likely to be very volatile for these two growth stocks. So just keep that in mind as you're considering investing in either of these two growth stocks. But if I had to pick one, I would pick Rivian. All right, thank you so much for watching. I really appreciate your viewership. I hope you'll tune in again next time for another one of these videos.